30 Key Takeaways from Chapters 10 through 12 of The Psychology of Money by Morgan Housel, with each point illustrated by a real-life example or story. Chapter 10, Save Money. 1. Wealth is determined by your savings rate. Takeaway. It isn't your income that creates wealth. It's the percentage of that income you save. Example. Two professionals may earn similar salaries, but the one who lives below their means and consistently saves builds long-term wealth. 2. Saving creates a margin of safety. Takeaway. Savings act as a buffer against unexpected expenses or downturns. Example. During the 2008 financial crisis, individuals with robust emergency funds were able to weather the storm without liquidating investments. 3. Saving is within your control. Takeaway. Unlike market returns, you control your spending and savings habits. Example. Someone who automates transfers to a savings account avoids the temptation to overspend, regardless of income fluctuations. 4. Avoid lifestyle inflation. Takeaway. As income rises, keeping spending in check is essential to build real wealth. Example. Many in the FIRE, financial independence, retire early, movement deliberately maintain a modest lifestyle even as their earnings increase. 5. Consistent savings compound. Over time, takeaway. Regular saving, even in small amounts, leverages the power of compound growth. Example, an individual starting to invest in their 20s will see modest amounts grow exponentially by retirement age. 6. Savings provide financial freedom. Takeaway, money saved today gives you the options to take advantage of opportunities or weather hardships later. Example, a small business owner with adequate savings can invest in innovation without resorting to high-interest loans. 7. Frugality can be more valuable than a high income. Takeaway, managing your expenses wisely often outperforms simply earning more. Example, a frugal lifestyle enables someone to save enough to retire early, even if their salary isn't top tier. 8. Emotional control comes from saving. Takeaway, having savings reduces anxiety over unforeseen costs and market volatility. Example, investors who save diligently are less likely to panic sell during market dips because they feel secure. 9. Savings build independence. Takeaway, the money you don't spend gives you the freedom to make choices based on what you truly value. Example, a person with significant savings may choose a lower-paying job that offers more personal fulfillment rather than chasing a high salary. 10. The habit of saving outlasts market cycles. Takeaway, good saving habits are sustainable across bull and bear markets. Example, many long-term investors maintain a fixed savings rate, ensuring they stay invested and benefit when markets eventually recover. Chapter 11, Reasonable greater than rational. 11. Perfect rationality isn't realistic. Takeaway, financial decisions must account for human emotions. Reasonable choices often work better than purely rational ones. Example, an investor who chooses a well-diversified, low-stress strategy over complex trading avoids burnout and sticks with the plan. 12th, personal fit matters in financial planning. Takeaway, a plan should align with your personality, risk tolerance, and lifestyle, rather than being the perfect model on paper. Example, someone uncomfortable with volatility might choose stable dividend-paying stocks rather than chasing aggressive growth. 13. Embrace a good enough approach. Takeaway, striving for perfection can be paralyzing. It's better to adopt strategies that are good enough and sustainable. Example, a couple may choose a reasonable retirement savings plan that allows them to enjoy life today rather than obsess over every percentage point of return. 14. Behavior over theory. Takeaway, your financial behavior, not just theoretical returns, determines long-term success. Example, investors who consistently avoid impulsive decisions, even if their strategies aren't optimal, tend to perform better over time. 15. Emotions influence financial decisions. Takeaway, Recognizing that emotions like fear and greed affect decisions can help you craft a plan you can actually follow. Example, a trader may opt for a reasonable portfolio allocation that avoids panic selling during downturns. 16. A reasonable plan is more sustainable. Takeaway, a plan that you can live with, even if it's not mathematically perfect, is more likely to stick over time. Example, many investors choose index funds for their simplicity and peace of mind rather than constantly chasing higher returns through riskier methods. 17. Balance risk with comfort. Takeaway, your investments should reflect both your ambition and your ability to sleep at night. Example, a middle-aged investor might reduce exposure to high volatility assets as retirement nears, trading off higher potential returns for lower stress. 18. Stick to what you know works for you. Takeaway, avoid mimicking high-performing strategies that don't align with your temperament. Example, an individual might favor a conservative, diversified strategy over replicating a celebrity investor's riskier moves that don't suit their lifestyle. 19th, rational plans must allow for imperfection. Takeaway, incorporate flexibility and allowances for mistakes in your financial strategy. Example, a retirement plan that accounts for market downturns and unexpected expenses is more robust than one based solely on optimistic projections. 20. Simplicity beats complexity in practice. Takeaway, the simplest plan that you can stick with is often the best, even if it isn't the most rational on paper. Example, using automated contributions to a retirement fund removes the stress of timing the market, offering long-term stability. Chapter 12, Surprise. 21. The future is unpredictable. Takeaway, no financial plan can account for every possible surprise. Flexibility is essential. Example, the unexpected COVID-19 pandemic demonstrated the need for contingency plans in both personal and business finance. 22. Expect the unexpected. Takeaway, financial history is full of surprises that defy expectations, so plan for a range of outcomes. Example, investors who held diversified portfolios during the 2008 crisis were better positioned to recover when markets rebounded. 23rd, build in a margin for error. Takeaway, always leave a buffer in your financial plan to absorb unforeseen shocks. Example, maintaining an emergency fund allows a family to handle sudden job loss or medical expenses without derailing long-term plans. 24. Flexibility is a financial strength. Takeaway, the ability to pivot when circumstances change is crucial for long-term financial success. Example, companies that quickly adapted to market shifts during recessions often emerged stronger than those that clung to outdated strategies. 25. Forecasts are imperfect. Takeaway, relying too heavily on past trends can be misleading. The future may hold events that no one anticipated. Example, the dot-com bubble burst surprised many investors despite historical data suggesting continued growth in tech stocks. 26. Plan to adapt, not to predict. Takeaway, instead of trying to predict every twist, design your strategy to be adaptable to change. Example, a flexible investment portfolio that rebalances periodically can adjust to both booms and busts. 27. Surprises create both opportunities and risks. Takeaway, unforeseen events can harm or help. Prepare to leverage positive surprises and mitigate negative ones. Example, an entrepreneur who had saved adequately could invest in a sudden market opportunity during an economic downturn. 28. Emotional resilience is key in uncertainty. Takeaway, being mentally prepared for volatility helps you avoid panic-driven decisions when surprises occur. Example, investors who maintained a long-term focus during brief market crashes were able to benefit when conditions improved. 29. Continuous learning helps manage surprises. Takeaway, staying informed and flexible in your approach allows you to respond effectively to unexpected challenges. Example, financial advisors who adjust client portfolios in response to changing market dynamics help safeguard wealth during turbulent times. 30. Accept uncertainty as part of the game. Takeaway. Recognizing that surprises will happen enables you to focus on strategies that work over the long term rather than trying to eliminate risk entirely. Example. A diversified, low-cost index fund strategy acknowledges that not all market movements are predictable, but it's designed to perform well over decades regardless. Each of these 30 takeaways from chapters 10 to 12 of The Psychology of Money emphasizes that overcoming bad financial habits, whether by saving consistently, designing plans that suit your personal temperament, or building flexibility to face surprises, is essential for long-term financial health. Real-life examples, from the experiences of individual savers, investors weathering crises, or companies adapting to market changes, illustrate how these principles work in practice.